All right, good afternoon, everyone. Hope everyone had lunch and is hydrated. Thank you for sticking around, and also for those of you who have just arrived, for coming to the Digital Asset Summit. It's really great to have you here. So now we're going to get to really the meat of what's happening in this space, which is tokenization in action. That was a really great presentation by Nadia from Hedera on from going from theory to practice. And so now we're going to talk about the practice part of it and look at it in action. So let's start with kind of the state of the real-world asset tokenization industry right now. It's gone beyond more than just a buzzword. But yeah, anyone can jump in here to start with. But what types of real-world assets are proving to be the most practical to tokenize first?
I guess I'll start. I'll start. So I guess to go back kind of historically, right? There's been a lot of trial and error, I think, in the asset tokenization space. It's been a narrative that started maybe around 2018, 19, where was mainly originally led by startups where the founders didn't necessarily have a good grasp of capital markets themselves. So I think we've seen waves of trial and error, mostly error in the first phase, and then the past 2-3 years really acceleration of institutional adoption, where I think we're getting to a point where we're getting to product market fit. So Nadine was talking about, for example, using money market funds as trading collateral, right? Those use cases, they really add something new to the asset type, really. Increasing the liquidity, enabling instant redemption, instant trading in and out. So we're finding, I would say, first is maybe the more boring assets that have found product market fit. So you have treasury bills, money market funds. They're also collateral worthy when it comes to stablecoins. And so that, because stablecoins have been growing, as a result, there is demand for these tokenized assets. You can use stablecoins to buy into them. You can also potentially use to back those stablecoins. And you need to have liquidity for stablecoin redemption, and so that's where the tokenization kind of comes into play. If you can redeem or at least trade out of the collateral, whether it's a money market fund or a treasury bill or something that is like yield bearing, then you can have a higher proportion of the asset, of the yield bearing asset, and therefore you can have better economics on your stablecoin. So it really has the real world implications. So we're finding that this is an area where it's supporting capital markets, supporting real world asset. It's in itself as a flywheel, and there are of course other asset classes where we find good product market fit. Real estate is an example. We talked about REITs one earlier. I think individual, maybe units or buildings, we see there's less demand for it because there's a lot of a need for the investor to really know, and do the research, and they tend to prefer more like diversified funds that are focused on real estate, as well as you need to have the critical mass of the asset itself so that you have enough of a market for it, you have enough demand, and you can have enough liquidity. So just some examples, yeah.
Great, thank you for that. Kelvin, from a bank's perspective, it'd be good to see what DBS thinks.
Yeah, so I think it really depends on the jurisdiction that you are in. And for us in Singapore, we have to comply with the legislation in Singapore. And the challenge that we face is that it's not so easy to tokenize things like real estate in Singapore. It's not supportive of crowdfunding. Typically, when you invest in real estate in Singapore, your name on the deed, when you change hands, you have to pay stamp duties in Singapore. So it's not so conducive to tokenize the real estate directly. And Singapore already has a very large REIT market where it's held in real estate investment trusts. And so the access to commercial real estate by retail investors is already widely available in Singapore. So that's not something that we're looking into. We have found that in our research that debentures, debt instruments are the best type of asset and the easiest legally to tokenize in Singapore, and so that's what we've done. We have tokenized a bond in 2021. Back then, that was on our private blockchain. Unfortunately, we realized that on private blockchain, there wasn't a lot of interest. So what we've done now is tokenize structured notes, which is essentially a senior unsecured debt, and we've tokenized it on public Ethereum. We think that with structured notes, because we can design any kind of payoffs, it would allow investors today in the Web3 space to be able to access these kind of traditional financial products whereby they can determine the payoffs for themselves. That's not something that's readily available in the Web3 world that we see today. And so, we're making it available to people holding USDC to be able to invest in such products via our distributors. So we've announced that we have partnered with 3 distributors, ADDX, Hedera X, and DGFT in Singapore. And of course, we'll be looking for more distribution partners to come.
It's really encouraging to see that a big bank in Singapore is tokenizing assets on the public Ethereum blockchain. I think we've come a long way to even get here. But speaking of blockchains, Marwan from BNBChain, what have you seen? Like, what's a trend you've seen in terms of what's getting tokenized first?
Yeah, thanks for that. I think Dr. Sabrina mentioned a lot of the good points, right? I mean, T-bills seem to be in terms of the real world assets of quality that we've seen tokenized the most on BNB, and we've seen like substantive liquidity there and a lot of utility integrated into the centralized exchanges. So I think no surprises there. I think that's probably the biggest one. But at the end of the day, we're a permissionless public chain, and a lot of our users are still retail, right? We have millions of retail users who traditionally perhaps enter this industry looking for the best yield, maybe from crushable sources in the past and previous cycles. And now there's a question of, well, how do we manage the expectations of people who have been so accustomed to great yields, especially retail users, and where do we find that balance in terms of where we can get actually high quality sources of yield from the real world to satisfy those expectations? And now where we're seeing this sort of splintering in the industry of there's still that degenerate culture of looking for the best yield, and still a lot more compliant institutional friendly entities coming in and offering kind of T-bills. So I think that's what we've seen with the highest PMF. And then we can talk about later, but like looking at kind of tokenized equities, things like that, new narratives coming in, which I think have been a lot more complex than perhaps we imagined. Yeah.
So thank you for that. Dr. Bo Bai, I mean, Alpha Ladder Group's doing some unique work, particularly with, the sustainability work that you guys are doing. Could you share some case studies of some assets that you've tokenized recently?
Thank you. Let me maybe share where I got wrong with RWA token about 8 years ago, and then the journey along the years, what I think about right now, and then what we're doing. So when I was a partner at Warburg Pincus before 2016, and then later I founded my own private equity firm, Asia Green Fund, we were trying to find the blockchain technology to create RWA token for illiquid assets, such as real estate. We actually invested a lot of real estate projects in China and Asia across. We invested a lot of wind and solar projects, carbon projects. So my initial journey was, let us try to use a new technology to tokenize those illiquid assets, trying to create a new market to solve the problem. That was stupid. I made a mistake. I embarked the journey in 2018 and 19 to apply for license. 2021, we were probably one of the first one to get the RWA token exchange license in Singapore, and then go down the journey. We tokenized carbon credits in 2021. We tokenized hash rate products in 2023, and then we later tokenized the money market fund along the journey. Where is the problem with the RWA token? Compliance, regulation, and then one of the biggest problem, end of the day, if you want to be successful, is liquidity, liquidity, liquidity. In our financial service industry, and then the bottom line is the payment, transaction banking, debenture, stock, structured products, and the funds, and then everything else. So you start with the bottom, and then it is the bottom that win the day. Stablecoin is a RWA token, and then they won the day because that has reasonable demand, reason for liquidity. And then I very much echo what my fellow panelists talk about, tokenized debenture. The more liquid, the better. Money market fund is carrying the day as we speak. Because it's lovely. Now, at some point, we're going to be able to do 724 interest on the token. We are reasonable interesting buyer of a USYC tokenized money market fund from Circle, Hashnode, and then we work with the other token issuers as well, because that's a liquidity. It is as standard product as possible. US dollar is very standard, and then stablecoin is successful. Money market fund is standard, and then tokenized money market fund will be successful, and then increasingly, as you add on it for other utilization, such as the example Hedera just demonstrated, use it as a collateral for FX transaction, and then in our Web3 world, what we're doing, we are using that RWA token for on crypto exchange trading. You make 3 or 4%, 4% return, and then maybe you make another 5% return on top of it. Everybody happy days. So that is the tokenization and liquidities create. And step by step, I think Robinhood is doing is fantastic. We are going to get it there. There's efforts with the SpaceX is a little bit weird, but for all those public stock tokenization makes absolute sense. The day will come very, very soon, and there's going to be a lot of firms like us who are licensed in Asia jurisdiction are going to create an Asia daytime market. Yeah. Because we are tired of living through the evenings trading the American markets. Let them trade the American days. Yeah. Let us use token to trade in Asia days and then make the instantaneous payments with the stable coins. I think that step by step, coming from the easiest standard, more liquid, and then step by step climb the ladder. So we are focusing on that to be as liquid as possible, and step by step maybe crawl back to where I came from, private credit funds, private infrastructure funds, and then private real estate funds units. Those are by legal structure, and the efforts is very easy. Only problem is, why should I buy it? So that's our perspective.
Well, thank you for that overview. That was terrific and makes a lot of sense. Actually, you pointed out two things, regulation and the risks that come with that, and then liquidity. But let's go into regulation and risks. And for anyone here on the panel, what are the biggest legal and compliance hurdles that you've had to navigate? You could start with Sabrina and then
So I guess to take a step back, I see there's typically two approaches to regulators, right? Either they will try to retrofit the existing securities framework, and just use that, and so you end up having to structure some sort of legal wrapper around it, some SPV or something. That costs money. That's it's not trivial, and so that also limits the asset size that you can put on chain. I would say the more forward-looking approach is to do a digital native issuance, which is not the norm yet, but you're beginning to see this emerge in places like Luxembourg, for example. So that actually makes things much easier, because if you have a system where you have to reconcile the on-chain digital twin with the off-chain, like a central securities depository, for example, you always have to make sure that there's a good solid link between the two. From a tech perspective, we try to put as much information on chain as possible, for example, for us at Tokenization Studio, to try and minimize that risk, because if you have a disconnect between the on-chain digital twin and the off-chain security, for example, you create additional risk. But yeah, we also on the receiving end, we're layer one, so we don't necessarily do the issuance ourselves, or we just try to enable all the issuers and the companies that build their stack for tokenization. But typically, the due diligence goes all the way down to the protocol. So it's like OFAC compliance, for example, how to make sure that the transactions aren't routed through a sanctioned country. So being permissioned, we can answer these questions pretty easily. Public versus private, also, those are things that are not necessarily compliance related, but also there's some sensitivity around that in the institutional world. So. I would say we're quite used to explaining, okay, what the technology can and cannot do, And additionally, there is the fact that transactions are not really easily reversible on the blockchain. So being able to enable that. So for our token service, we're able to actually freeze an account, wipe a balance, which that I think again that helps with the compliance and the regulatory aspect too. But it's typically not something that's standard in blockchain, and so there are some misunderstandings around that.
Yeah, I can imagine it'd be challenging explaining, and I guess the education that needs to come with all of these hurdles and compliance things that get put into place. Kelvin, has there been challenges, particularly?
Yeah, absolutely. I mean, there were three main challenges that we managed to overcome. The first challenge was a legal challenge, right? We had to find a way where it was cost-effective to issue tokens without incurring legal costs every time we did a new token. Unfortunately, Singapore's legislation hasn't been updated, unlike Switzerland or Luxembourg, where they allow for native tokenization. And so in the past, what we did with our first bond was that we had to get pay legal fees, create the legal documents to allow for a token to represent the bond document. And if we did another one, we would have to pay legal fees again. And so it was not very cost effective that way. Now what we did this time was that we updated our structured note program. It's at the program level. And so this allows us to create new structured notes and tokenize them without any additional legal fees thereafter. So this was a matter of scale where we can reduce the legal costs involved in each token issuance. So that's the first problem we managed to overcome. The second problem was a compliance AML problem, whereby just because we tokenize the security doesn't mean that we can sell it to anyone. It still falls under Singapore's Security and Futures Act. It still means that our structured note tokens can only be sold to accredited investors and institutional investors, which meant that we need to ensure that whoever is holding our token is allowed to invest in our tokens. And so we managed to create the Ethereum smart contract that had whitelisting capabilities, so we can whitelist wallets and ensure that whoever is holding our token is a known party, has gone through KYC. We also have the ability to freeze our tokens in the case where we detect any kind of AML or any kind of fraud issues. We can freeze our token, and we as the issuer and the custodian reserve the right to force transfer those tokens back. So these are three new technology innovations that we had included into our smart contract that therefore gave MAS the comfort to allow us to issue onto public Ethereum. So I think this was quite a big challenge that we managed to overcome, and to be able to assure our regulators that we are in control of these tokens and that they're not going to be transferred to anyone anonymously and end up in sanctioned countries and so on, right? So that was the second challenge we had to overcome. The third one is very unique to banks. So those who are in the banking industry would know that under Basel III, there is a new framework called the SCO 60. And under that specific framework, Basel has worded it such that any token issued on the public blockchain, even if it's a tokenized real asset, would be classified as Group 2B and would attract a 1,250% capital charge on the risk-weighted asset to a bank. And so that's extremely punitive. Now, what we've managed to do, and with the concurrence of our regulator, is that because we are the issuer of the tokens, that capital charge doesn't apply to us. Now, if another bank were to invest in our tokens, that's something different. But when we sell it to accredited investors or institutional investors, they're not banks, so they're not affected by the capital treatment. And so that was the third challenge that we managed to overcome. And I think, this is also now causing a lot of the banks to also lobby with Basel to try to change this. But that hasn't taken effect yet. But we've gone ahead and we've managed to overcome this with the blessing of our regulator. So I think those were the three big challenges that we managed to overcome to allow us to issue on public Ethereum.
Well done. It sounds like it takes a lot of creative thinking, and innovation to work around those hurdles. So yeah, very, very impressed to hear.
I'll just jump in. It's interesting to hear Kelvin's perspective because BNB, at the end of the day, it's quite simple. We're a permissionless chain. So a lot of the legal tax or the responsibility, typically, at the end of the day, does still live with the protocol because we can't technically control what is issued or not issued on the chain. But the best we can do is, one, reassure the regulators that these assets are issued in the most compliant way. And where we have our greatest leverage is in the ones that we back, the ones that we invest in, we do extensively DD for those assets and so kind of the compliant frameworks that they're using, or encourage them to be as compliant as possible. And that's kind of the extent as a chain where we can create that, exert that influence. At the end of the day, like we're dealing as an ecosystem with all sorts of markets. So of course, there's the T-bill question and kind of those traditional assets, but we're looking at other frontier markets that are, still perhaps arguably in the gray area that we're also trying to keep tabs on and kind of looking at compliance from those perspectives as well. So the simple story is we for our portfolio protocols, we will push as hard, and for the ones that were not on our portfolio, we can encourage them as much as we can to stay compliant.
Maybe also similarly add on 3 points. Number one, regulatory. I have operated in US, Hong Kong, mainland China, and the Singapore market. I've been here 5 years. I love Singapore. And the reason is there is only one regulator that covers all the aspects, but when you go to other jurisdiction, it's a pain in the neck. And then because of that, whatever token that RWA token side we do, if this is a DPT token, it's a DPT token. If it's a security token, if it's an equity token, if it's a debenture token, it's a CIS token, it is corresponding token. If it's a structured notes as a debenture token, it is a debenture token. If it's a digital deposit receipt, it is a digital deposit receipt. The law has specified here very well clearly allow industry practitioners to really work in as clear way as possible, where in other regime, for example, I'm not going to name names, a certain one of the biggest RWA token guy in the States, they call ABCD financial tokenization. And then that company, if you drill deeper, they are a tech service company. They call it ABCD Finance. Okay, so this is number one. Singapore has probably, based on our current experience, the best regulation to allow you to follow PSA or SFA to act, number one. Number two, on the compliance and the regulatory side, RWA token itself is nothing too different from going an IPO process. You have to have assets, you have to have the stuff, and then you have to have the rules and the technologies to make it happen. If you're holding structured notes, you're holding debentures, you need a custodian of traditional security. You need a custodian of such a security token to hold it. So that license comes with it. And then Singapore allows you to do that as long as you applied for it properly. Relates to RWA token, particularly when you go down the path of wind, charging stations, solar panels, RWA token. There is a key word in technical guys we call GIGO, garbage in, garbage out. If you don't know you have that assets, it is nothing. So in order to represent the real world assets, you have to create a digital twin, just as Sabrina said, for that. And then, which is why 5 years ago, we filed a patents to combine the digital twin of Industry 4.0 and blockchain technology, which we call NFDT, non-fungible digital twin. Many of you played with the NFT. We always say NFT is for dead assets. A Picasso painting, don't paint more stuff on it. You're going to destroy the value. But if you're going to tokenize a real estate, tokenize a wind projects, every day you have new information added to it. That digital twin needs to have unique representation in the digital world. We are very proud that we got the international PCT approval a couple years ago, and we're also awarded the Singapore patent for our non-fungible digital twin technology as underlying tech platform to make RWA, the real world, real assets, into its avatar first. There's only one unique one in the digital world owns the real world. And then based on that, you create a token. The token may be a debenture. The token may be equity. Very, very similar to how in the real world you think about assets, you think about capital structure. Number two. Number three is absolutely agree is the AML and the KYT. It's very, very hard. We have done our very interesting research. We bought 6 tools: Chainalysis, Elliptics, Merkle Science, Building, and there's another one, Snowmist. And then we bought 6 tools, we API'd 4, and then we created additional analysis on top of it. And then we recommend to the industry, use 3 tools at least, but no more than 3. The marginal benefit is too minimal. We move from 3 to 4 tools, but at least use 3, because 2, you will sometimes underestimate the KYT AML risk by 25%. So we actually published the research reports, happy to share as well. So all that efforts, when you go down the path of bringing this to public chain, whether it's ERC20 or ERC3643, as you guys might be doing, and then use the stablecoins to make that payments, that KYT, that AML, that CTF is paramount. And then we have spent a lot of money, a lot of efforts to tackle that. So with all those legal and compliance become more mature in Singapore, with the tech platform to become more mature to handle the real world assets, and with the KYT and AML CFT tool to become more powerful to minimize the AML money laundering risk, I think this is the prime time for the RWA token to finally, step by step, taking off.
Thank you for the overview. It's very encouraging to see that's actually a lot of work that's been done over the last, few years into making real-world asset tokenization reality. We're just almost running out of time. I do want to just take a step back and just hear from the panelists about looking ahead to where we see this going. I think Dr. Bawai, you talked about liquidity and building from the base layer of like stablecoins. So we've seen stablecoin, what people call stablecoin summer this year, and there's been many announcements of multiple stablecoins being announced, integrated, and adopted. And so it starts from there. Which other parts are leading the way? Where do you guys see it going the next year and beyond?
All right. So I guess we've come a long way already, but we're still in a transitional phase where there are assets that are on-chain, off-chain. We're still not fully digital native. So I think that's the end goal, really, digital native on most asset classes. With a payment leg that will be stablecoin based, right? So you can start having delivery versus payment, and you can have the full benefit of asset tokenization. And then on top of that, we're going to be adding a layer of automation. So AI is going to come into play, where you can start automating some of the trading, some of the operations, the KYT and the screening. So really fully digital native and very much more automated than we are now. So I think we're in a kind of awkward phase right now. We're trying to retrofit some of the, build some middleware between the TradFi layers and the tokenized layers, but eventually, I think that's gonna go away. So, yep.
We kind of look at this in 2 perspectives. One perspective is that blockchain technology and tokenization of assets is going to replace the backbone of the financial infrastructure that today banks use and custodian banks and all of them that we're using. But this, we have to recognize, is going to take a very long time. I mean, there are over 30,000 banks in the world, 15,000 banks are on SWIFT, and SWIFT just announced that they're going to go on, introduce blockchain technology into their messaging. But the reality is that SWIFT introduced the ISO 20022 messaging standard more than 10 years ago, and yet majority of banks are still using the MT message format from 30 years ago. It's going to take a very long time for the financial industry to migrate into that new world. I think it will happen, but it's not going to happen as quickly as we all thought 5-10 years ago. So then we look at the on-chain world and the Web3 world as a new liquidity venue. We know that the traditional markets are not going away, they're still going to stay, but there is now sufficient demand and sufficient liquidity in the Web3 world with Bitcoin, Ethereum, stable coins rising in market capitalization, hitting almost 4 trillion, that there is now a lot of demand for real-world assets, because things like DeFi yields, like Terra Luna's collapse, have kind of shaken some of the people there, and they realize that it's not so easy to get 100% kind of yield. It's not realistic. And whereas TradFi yields have been around for decades and is very well tested. So now when we look at that, as my fellow panelists have rightly pointed out, is liquidity, liquidity, liquidity. And so we look at that as a new liquidity venue, and we offer our products to that new liquidity venue. Yeah. I mean, we distribute our structured notes today traditionally through other private banks, to security houses, and this is just a new distribution channel. So while we're waiting for the world to slowly move towards a fully digital asset blockchain world, there is still Web3 liquidity that is looking for real asset tokens.
Nicely said, and yeah, going to BNBChain.
On Kevin's point, you know, as a chain, we're building, you know, there's short-term games and long-term games. I think the long-term games is precisely what Kelvin mentioned, right? Stablecoin payments, I'm sure you've heard that. There's no shortage of chains launching or trying to tackle that product opportunity, but it will take a very long time. So we have to continuously build that trust, build the institutional relationships, the infrastructure to accommodate that, and I think it's still unclear. The jury is still out on who's going to win that, but that's going to take time. And in the short term, we're playing, as a chain, we're still playing games of relevance, meaning, you know, you'll see every cycle, you know, there are asset standards, there are categories that, you know, you thought perhaps had died and probably belonged to a previous cycle, but they're still here and are still instrumental to building that relevance. And we also still have to play those games. So, you know, it's sometimes not always in the RWA space, right? This cycle, we've seen other sorts of products do very well in terms of providing yield or offering new use cases on chain, right? Prediction markets have been all the craze as well this cycle, and there's literally 100+ prediction markets now in the space. So we have to optimize for those two things. So long-term, completely consensus view, I think, with the rest of the panel. Short-term, we'll also have to look at those other innovative categories to make sure we can play the long-term game.
Number one most interesting thing right now is stablecoin utilization for cross-border payments in the real world. We are very focused on the Asia-Pacific, Middle East Africa, and Latin America. It's in these developing countries that are sending export-importing that the stablecoin becomes very useful. We rolled out our platform called StableX, fiat to stablecoins without go through SWIFT in another country, and then stablecoins to fiat. And that has been gaining a lot of tractions and really solving the pain points. And then we are stablecoin agnostic. We serve Tether, Circle, Repo, FDUSD, and we're chain agnostic, working with the BNB and other public chains, connected with the stable of Tether and the Oracle of Circle, and so forth. So that's number one. Extremely, extremely exciting is the first phase of stablecoin is utilized for hopping on unregulated exchanges. But right now, the most fascinating thing is the stablecoin is changing the transaction banking at the bottom of the bottom for cross-border payments. Number one, very interesting. And RWA token side, the most interesting, obviously, is the tokenized liquid assets go as much as possible. The tokenized, money market fund or debts, and then blue chip stocks. And then with that as a collateral for other transactions, I think this is phenomenally interesting. So both are money-making efforts and interesting at the same time. The last one is the fun part that doesn't make money, is carbon stablecoins. And then it's our 6 years journey. 5 years ago, we filed another patents of carbon stablecoins. We got the patents globally as well as Singapore this year. We want to elevate carbon stablecoins for cross-border payments. We registered in Singapore as a CAS token, and we carried out tens of thousands of dollars from Europe to carbon stablecoin, and then carbon stablecoins to offshore RMB that gets settled in T+0. We can make even carbon stablecoin RWA token work for cross-border payments. Absolutely not making money, but it's my hobby, and it's absolute fun.
That's great. Can everyone please join me in thanking our panel? That's a great way to end it. Thank you, guys. Thank you, Dr. Vo, Dr. Sabrina, Marwan, and Calvin. Thank you.